Hello and welcome back to another episode of the For the Property Investor podcast. And we're here with, of course, the weekly news, because if it was any other face, it would not be the weekly news. So welcome, Nick Bendel, because this is the face that I'm talking about.
Yes. Hello. This is the voice that's connected to the face. How are you?
I am pretty good. I'm pretty good. It's what's been happening in your week, Mr. Bendel?
Well, I've had a very enjoyable week. Could I say productive week as well? I've got a business called Hunter and Scribe, which writes content for finance and property professionals throughout Australia. And last week, Owen, I gave a presentation at an accountants event about how accountants can use LinkedIn to build a strong personal brand and generate more leads.
Oh, accountants building personal brands. That would be interesting.
Yes, indeed. There are some accountants out there who are very good at it.
Wow. Are they unicorns?
Well, they might very well be.
Okay.
There are some accountants with very strong personal brands, just as there are some property managers with very strong personal brands. Do you know any?
Well, yeah, I try. But yes, there are some other property managers I know with very good personal brands. So yes, they're out there, and I'm sure so there's some accountants as well. And I might know one or two. Yeah. So well, it's very interesting. It's yeah, it's I've been pretty busy myself in the past week. It's we've been leasing lots lead up till Christmas. Lots of leasings. So much so we've had a new staff member start today, who's going to be our new leasing manager, which will be managing the leasing process for every single property across the country, making sure that every client has got the one person to talk to about all their properties getting leased, and at different times and different places. And so her job will be to manage our staff on the ground, process all of the applications that come in from tenants, and then talk to owners about getting them approved and then getting the tenants onboarded into their new home. So yes, looking forward to that. Progress in that new role that we've invented so that we can service more clients and have some specialists in specific roles. So yes, that's been our day today, and been leading up to it for the past week. So yeah. Nick, have you brought some news with us this week to talk about?
I have indeed. I may be forgetful, but this is one thing I would never forget. We've got three interesting stories today. The first one being mixed news on the inflation front. The latest inflation data shows that annualized inflation has now risen for 4 consecutive months, from 1.9% in June to 3% in July, 3.2% in August, 3.6% in September, and now 3.8% in October. However, when you dig into the data, you discover that it's better than it initially appears. Over the past 3 months, prices rose by only 0.4%, which is modest. But by comparison, prices actually fell by 0.4% in the same quarter last year. So when the October 2024 quarter numbers dropped off from the annualized result and were replaced by the October 2025 quarter numbers, it caused the annual inflation rate to rise. Looking ahead, prices rose by a significant 1.1% in the final 2 months of 2024. So if prices rise by less than that amount in November and December of 2025, the annualized inflation rate will fall. So Owen, as we've discussed, the latest inflation numbers contain elements of good and bad, but how seriously should we take the fact that annualized inflation has now increased for 4 consecutive months?
Well, yeah, it is a serious issue that needs to be taken seriously. But yeah, we called it what was it, about 4 or 5 months ago, when we were looking at these sorts of issues, and with taking into account what had happened in 12 months ago, and we could see that we had very low inflation figures 12 months ago, but we were having higher inflation figures this time around. So we could see that this was going to happen. It was very simple, and but it's funny how people in the media, and it seems like people in the government too, no one else has brought this up. So it's maybe we're the only bright sparks here, Nick, seeing what's out there, as simple as can be. But yes, as pointed out in the article, we might have the reverse thing happening in the coming months. So let's just wait and see.
Just a few months ago, annualized inflation had fallen to 1.9%, below the RBA's target range, and it seemed we'd finally defeated inflation. With the benefit of hindsight, we can see those celebrations were premature. Do you have any theories as to why we haven't been able to put this inflation genie back into the bottle?
Well, it's the biggest issue is government spending. It's the government's trying to keep the economy ticking along quite well, and they've used two very short-term levers to do that. Number one is to increase spending and demand by having high immigration figures, and then there is government spending to pump money into the economy. So they're the two main factors. It's like feeding the economy cotton candy, and we've got a sugar high, but it doesn't last very long, and there's no substance to it.
So very interesting, your answer. So a lot of people would say that this inflation problem, we've had it for about 3.5 years now, that if we haven't solved the problem, it must be the RBA's fault. But you've made the point that actually the federal government has a bigger impact on inflation than the RBA.
Well, yes. I mean, yes, the RBA can use the stick to knock inflation on the head, but that makes them the bad guy by putting higher interest rates into the marketplace, and they don't want to kill off the economy. But if the government pulls the lever of government spending and putting demand into the economy, then it makes the inflation problem worse. So yes, the RBA is looking at it, going, do we need to raise rates again? And the government's pleading there, going, no, 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 no. Let's not do that. But at the same time, they're feeding the dog under the table, and it's not a very healthy diet what they're feeding.
Are they feeding the dog cotton candy?
Oh, well, that would be very unhealthy for the dog. Yes, could cause some very painful visits to the vet.
Now, you mentioned before about the RBA hypothetically raising the cash rate. The RBA are making their next cash rate decision on December 9. So what should they do? Cut, hold, or hike?
I suspect they'll hold. The RBA board can see the figures, and I suspect would be looking at the figures from 12 months ago and what will be falling off the 12-month rate and what they would be expecting to come in over the next 3 months. So I think they'd be waiting to see what happens and just let it all play out. But I think they might be letting the story out there that, whoa, maybe the next rate change could be a hike, and that'll make everyone think twice about spending more money.
You know what I do, and I can be a little passive aggressive. I think I would raise the cash rate, and I'd put out a statement saying, in not these direct terms, but we had to raise the cash rate because the government has been spending too much money and we were left with no choice. Now, of course, they can't say it that explicitly, but you can say it in an indirect way that gets the same message across. As I say, I'm a little passive aggressive, so that's what I would do.
Well, yes. If I don't necessarily disagree with you then, Nick, but yes, the RBA tries not to get political.
See, the problem is we've been dealing with this for 3.5 years, and it's like they've been trying to slowly pull the Band-Aid off. And my approach is to just rip off the damn thing. It's more painful in the short term, but it's less painful in the long term.
Yes, I know, but we spent many years before this feeding the whole country cotton candy, and when they didn't deserve even a little lolly, but we put them in the position where we had to because of other reasons, which we won't go into again. So yes, it'd be like giving that 5-year-old cotton candy, letting them have one bite, and then taking it away from them. Yeah, who wants to have that whinging little so-and-so, yeah, in the back seat of the car the whole way? It wouldn't be a pleasant ride.
No, it wouldn't. Well, thankfully, our second story, I think will put you in a much better mood if I know you as well as I think I do. APRA intervenes in mortgage market. APRA has decided to limit high debt-to-income lending in order, quote, to preemptively contain a build-up of housing-related vulnerabilities in the financial system. From February 1, authorised deposit-taking institutions, or ADIs, will have to limit their share of new home loans with a debt-to-income ratio of 6 or more to a maximum of 20%. To put it another way, ADIs will have to ensure that at least 80% of their new mortgages have a debt-to-income ratio of under 6. The new limit will apply separately to ADIs, owner-occupier, and investor lending. APRA said the new limit is not expected to have a near-term impact on borrowers' access to credit. APRA said only a small number of ADIs are expected to be near the limit for high debt-to-income investor lending at this stage. Should levels of high debt-to-income lending rise towards the 20% limit over the coming period, this limit will act as a guardrail and is expected to have greater impact on investors who typically borrow at higher debt-to-income ratios than owner-occupiers. So, Owen, APRA says that while, quote, overall bank lending standards remain sound, they have, quote, observed a pickup in some riskier forms of lending over recent months and were, quote, not prepared to wait for housing-related vulnerabilities to build up before acting. Do you agree with APRA's position?
Yeah, this was an interesting one when it came out because it's the first time that APRA has used this lever. So it's a way of them looking at a different lever to pull that. It's a more subtle one, and so it's Yeah, so my take is that it's a good move, because it's not a blunt instrument. It's a very subtle one, and and it looks to just smooth out the edges of our lending market.
Could we say that APRA are removing some cotton candy from the lending market?
Um, uh, yes, but it's I think I know what you're referring to here, Nick. Yes, especially I mean, it's more likely to affect investors, as you've read in the article. But there would be a certain number of owner occupiers, especially if they're buying at high LVRs, such as like a 95%
Mm.
loan, um, and which it might affect, but which I think you might have been referring to. But those the lending limits on those 95% loans were already fairly strict. So yes, it's and there has been a lot of investor activity in the past in this year. So it might be just trying to smooth out the edges. I
Hmm.
wouldn't be too concerned.
You know, a few days ago, I met a broker and he told me he's got a client who in the past 12 years has gone from 0 investment properties to 105 investment properties. And he's purchased all of them with LVRs above 80%. So maybe if we take this guy out of the market, maybe he's the one who's distorting the figures.
Oh, maybe. Does this client need a good property manager?
Well, very good question. I should ask.
Yes, yes. I'd be interested in having a chat. But um, putting that aside, it's yeah, it's interesting to buy 105 investment properties. There'd probably be some special purpose vehicles in there,
Mm.
which probably wouldn't get affected by this. But some banks have been self-regulating with special purpose vehicles, such as trusts, to be able to buy investment properties in. So, but that wouldn't necessarily be affected by this APRA intervention.
Now, your good friends APRA, they say that signs of a build-up in risks, quote, are chiefly concentrated in high debt to income lending, especially to investors. Last week, Owen, you said it was unfair that investors would charge higher interest rates than owner-occupiers, but given what APRA is reporting, shouldn't investors actually be paying even higher interest rates?
Yeah, don't quite see the logic there. It would be, if we want to bring down the debt to income lending, then we might want to lower interest rates for investors.
Mm-hmm.
Yeah, so that might be helping out there. But no, I don't think investors should be paying higher rates. Um, it's for equivalent loan to value ratios and loan amounts, and for equivalent security types of security. So if there's a higher security, whether it's an owner occupied um, property or investor, then the banks should be charging the same rate. There's no relative higher risk just because it's an investor. Yeah, it's there could be some market conditions that could make it higher risk in certain areas. So yes, but a blanket higher rate for investors, yes, I think is unnecessarily, and I think it's just price gouging because they can.
APRA also said they would, quote, consider additional limits, including investor-specific limits, if we see macro-financial risks significantly rising or a deterioration in lending standards. Oh, and that got me wondering, do you think APRA are signaling that further restrictions are coming?
I think they've taken the opportunity to put it out there that they are always looking at further restrictions. and interventions. Just like the RBA might hint at the next rate move being in the upwards direction, just to make people think twice about taking further risks.
Let's move on to our final story. New report paints grim picture of rental market. The 11th Annual Rental Affordability Index, released by SGS Economics and Planning, shows that while rental pressures have eased in some markets, the overall national picture is that renting is tough, especially for people on lower incomes. Sydney is regarded as a severely unaffordable rental market because households have to spend 38% of their income on rent. 4 capital cities are regarded as merely unaffordable rather than severely unaffordable. Perth, where rents are 36% of household income, Brisbane 34%, Melbourne 31%, and the ACT 31%. And 2 capital cities are regarded as moderately unaffordable, Adelaide at 27% and Hobart at 25%. SGS Economics also said that while rental affordability, also said that rental affordability had progressed from being merely a question of social welfare to a threat to our productivity and prosperity. Quote, essential workers from nurses to teachers to police officers can afford less than 2% of rental properties. Businesses report chronic staff shortages, reduced operating hours, and diminished competitiveness because their workers simply cannot afford to live where the jobs are. When workers spend hours commuting, when businesses can't attract talent, when young Australians abandon career opportunities due to housing costs, our entire economy suffers. So, Owen, your property management business, Leafield, you operate in 5 states, so you always have a fantastic overview of the rental market. SGS says our capital city rental markets range from moderately unaffordable in some cities to severely unaffordable in others. Is that a fair assessment?
Yes, it is fair. And, my comment about this is they always note essential workers such as nurses, teachers, and police officers. But I've seen what incomes that nurses, teachers, and police officers earn, and there's a lot of people who are essential, could be considered essential workers, but maybe just general population who are working, and it's essential for them to work, who earn a lot less than these essential workers. So if it's unaffordable for them, I think it's been made pretty clear that whether one market is severely unaffordable or merely unaffordable, it's to moderately unaffordable. I think all rental properties are generally considered unaffordable for most workers. Yes, so let's not keep on focusing on essential workers, because it's the whole population that is having an unaffordable crisis with rental properties. So that's my soapbox moment, because yes, they keep on focusing on those people when it's everyone. It's white collar workers, it's blue collar workers, it's so-called essential workers as well, which they are essential, but everyone is essential to the whole economy to keep on working, and we need affordable housing. So yes, and to provide more affordable housing, we might need more supply of rental properties in the marketplace, where people want to and need to live and work. So yes, we need more supply in the marketplace of properties of all types across the country.
What do you think about that other interesting thing that SGS raised? Do you agree with SGS that rental affordability plays a key role in our national productivity and prosperity?
Yeah, absolutely, because we need affordable rental properties across all markets across the country, to be able to have a workforce that is that's easy to migrate across the country, so that they can move from market to market quite easily, with it being affordable to do so, to move where the jobs are, and so that businesses and industry can hire a workforce when they need to, and know that that workforce can get affordable housing to live in. Otherwise, that puts more pressure on wages, which then puts more pressure on inflation, which then puts pressure on interest rates. So, yes, it's a whole economy, it's a whole system, and yes, people need to realize this. So, but the one thing that can make the biggest difference here is more supply of housing.
Okay, so then how do we get more supply?
Well, we've talked about this ad nauseum,
Have we?
Nick. Yes. If it's not every episode, it's every second one at least. Supply and demand, we've said it 1,000 times. So, um, yes, we need it easier to get approvals through for more new dwellings. We need to get them financed. We need to get them built as quickly as possible. So it's cutting red tape. It's cutting the costs of materials. It's the rising cost of labor, as well, is a problem with that. So all of those things are putting pressures on the increase of supply not happening. So we need to address all of those issues. So yeah.
Well, really, really good chat today. What I'm taking from this is we need more housing, less cotton candy, and Australia will be in better shape.
Absolutely. Less cotton candy is good for everyone, whether it's the sugary type or the monetary type.
Well, thank you so much, Owen. Always enjoy our chats, and I look forward to speaking next week.
Thanks, Nick. We'll look forward to hearing what's in the news next week.